You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And with me today, nationally recognized life insurance expert Bobby Samuelson. And we're talking about the number one most popular product on the street today, indexed universal life.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me, day 4, Bobby Samuelson. Welcome to the show again, Bobby.
Great to be here.
We're talking about, I just saw the number on first quarter sales. Index is a monster right now. It shouldn't be though. I say it's taken over the world, right? But should it be? Let's talk a little bit about the mechanics, because I really want to demystify. We talk about cap spreads, participation rates, but aren't they kind of all the same thing?
Yeah. So you're asking a lot of questions all at once. So I think the question is, should it be hot right now? Yeah, there's a really cool story here, right? Mm-hmm. Interest rates are low. People like the idea of having upside potential and downside protection. And I do think that's a part of the reason for the sales. But I think there's this whole other world out there of the way index fuel is being used, and there's a lot of leverage there. So the way I kind of divide it up in my mind is you got people who are buying into the asset class story of index 2L, which is I like upside, I don't like downside. And index fuel gives me exactly that, right? Upside potential and downside protection. Mm-hmm. And then there's this other side of the house where people are showing 8% or 7% or 6% or 9% of their clients saying, you should buy this product, it's going to give you very high performance, and we can leverage this up with premium financing or variable loans or all these other things in here to make this look really good, and that's why you ought to buy this product. And then there's this whole other segment over here, which is, I would call them kind of commission-driven sales. You have rebating in California and some of this other stuff that's really kind of shady business. That's not real insurance transactions. It's just because commission is so much higher in indexed UL products, you kind of end up with more of that noise in there than you get another product. So again, your asset class sales, illustrated rate, leverage type sales, and then you got kind of commission driven sales. And it's really hard to tell why the sales are coming around. It's really hard to differentiate one from the other. And so it's really challenging to know whether indexed UL momentum is sustainable. And to your point about cap spreads and whatever else, how all that, if caps change and spreads change and all that sort of stuff, how's that going to impact sales going forward? And are we going to see caps falling in the future?
Well, let's go to your first thing, because this is the last time I had you on this show, and this caught a lot of flack out there. This product was constructed to be about 200 basis points above the prevailing interest rate market. If the prevailing interest rate, and this morning when I checked, the hottest contract that I can actually sell with a conscience is right around 4.75. So if I'm at 6.75 using that kind of indicator,
right.
If that's it, I don't know if I should be showing anything over 7.
Yeah.
I'm just from that design issue alone.
Totally, I agree with that. And I think one of the challenging things is, people say index fuel is, I've heard this before, index fuel is constructed to deliver 200 basis points. Well, if it was that easy, right, think about that. If it was that easy to say, well, I'm going to construct this product to deliver 200 basis points, why stop at 200? Why not get 400 or 800 or 900, right? So the reality is, when people say it was constructed to 200 basis points more, that is sort of true, but it's also sort of not true in that carriers really don't know how these products are going to perform, because none of them have had them long enough. The longest carrier in the market is 1997, it's Transamerica. And every other carrier's had it later than that. Any carrier data we've actually seen from carriers about their in-force performance, their blocks of business, actually show indexed UL performing very comparably to current assumption UL. So I would say, look, 200 basis points, I think is pretty aggressive. And so anything over 675, I think is to your point, way out there. And I usually say, look, policy charges are higher in indexed ULs. So you should give them a 100 basis point bump over current assumption UL, and that's it. So illustrate 5.75 or 5.5 or whatever else, and that to me is pretty
we just had a carrier come out with a huge piece from the Monte Carlo model, taking two 20-year tranches of the returns at 5.5. It was 100% predictability. That they were actually saying that. So when I look at that number, if I sat down at 5.5 and I used my best whole life dividend, if I was doing an income scenario, the index UL is still going to win.
Yeah.
Remember, and keep in mind, when I say that, I have to say we're suppressing the death benefit. We're doing a lot of things here to make the income. But back to your point now, I'm thinking if 200 basis points is probably my rule of thumb, not a actuarial indicator.
I would say that's your upper limit.
It's your upper limit. If I'm 200 above current assumption and I shouldn't be outside of 7, right? I mean, just based on that, then I'm going to look at the mechanics of going back to people and saying, here's, especially if it's death benefit, that's one thing, because the difference between maybe 7 and 6.5 is going to be marginal as far as the premium.
Right.
But it makes a lot of difference when we start talking about income scenarios, especially when you threw on the issue of variable loans.
Right.
Now, I have you on the show. I might as well get to it. The only reason why these things look like they are dynamite is because the carriers that show arbitrage loans, those numbers are so unbelievable. And yet, Bobby, I've never seen anybody run the last 10 years in a distribution. They do it in income, but they don't show it in distribution. Now, when I see that, I got like S&P down 2001, 2, and 3, and 8.
Yeah.
If I was taking arbitrage loans during that time, I'm going to get killed.
Right.
So talk a little bit about this, because this is where we haven't addressed it. We're still showing 8, and now we're saying 6, and now we're talking about arbitrage loans, and we just came out of 4 out of the last 10 years in loser years for distribution.
Yeah, so I mean, this is the real challenge, right? You have a sheet of paper, it's called an illustration, and it shows a perfect world scenario where they're 8% every year, and the loan charge rate never changes, which with some companies, they do guarantee their loan charge rate.
Right.
But companies that guarantee their loan charge rate don't talk about how loan charges interact with the cap, because they do. So there's all sorts of commingled things here, right? And then it's all slapped on this sheet of paper where everything is constant, nothing changes, and everything's perfect, and your arbitrage loan scenario stays there forever. So the reality is, there's a big breakage here, and in the last 10 years would have been a huge breakage, and producers just flat out aren't equipping their clients to deal with the breakage of the illustration to reality, and I think that's the biggest challenge for Index UL, is how it's going to line up illustration to reality.
Well, I wrote this article a couple weeks back called Life Insurance Proposals, Vapor on Paper, based on our last time I interviewed you. That went all over the web, and we took significant heat. But we're willing to take it because actually that number turned out to be correct. When we come back, we're going to talk more about indexed UL during accumulation and distribution.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Helping people with their finances is a great responsibility. Taking care of the families you serve requires more than just providing protection. It means helping them take smart steps towards building a successful future. A good first step is offering the Ultra Index, a low-cost life insurance product that accumulates cash values your clients can access for emergencies, college tuition, or additional retirement income. That's the Ultra Index from Lincoln Benefit Life, an Allstate company.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, and of course with me is Bobby Samuelson. We're talking about indexed UL. I love indexing, but there's a lot of moving parts here. I tell you what, I got to tell you, if I don't get 5 to 6 emails a day on the mechanics, how does it work? Arbitrage loans, I mean, huge influx of email on arbitrage loans. What happens during distribution in the bad boy years, as we were talking about in the first segment. But there's a lot of parts that relate to each other that we really don't see. Like you were talking about caps and loans. Well, I thought, well, caps are caps.
Yeah.
Right? Loans are loans. What does that have to do with each other?
Yeah, great question. So this is something that I think is really challenging to think through. But a policy loan is an asset on the carrier's books. So basically, it's really simple logic. If you guarantee the cost of the loan, so let's say you guaranteed it 5.5%, let's say 5%. And interest rates drop to 2%, then you wish you didn't have a guarantee, right? Because you wish you could get money out of 2%. So if you choose a carrier that has like a Nationwide that has they have their linked up to AAA bonds, okay, well that's great. When interest rates go down, your loan cost goes down. So that's good. Now, when interest rates go up, let's say interest rates go to 7 or 8%, that 5% loan looks very attractive now, right? But the problem is this: if interest rates go up to 8%, the cost to hedge is also going to increase. All right. And so when the carrier takes in your premium dollars and they go to invest it in bonds that are also earning 8%, right? They can give you a higher cap if they're earning 8% and then the cost to hedge has gone up, right? So they're spending 8% on the hedges. But when lots and lots of policyholders see that 5% loan option and start taking about 5% loans, Now, instead of having 8% bond assets, the carrier has 5% loan assets. So the overall performance of the portfolio goes down, which means that the cap is also going to go down relative to what it would be if loan rates were equal to bond rates. So it's not a bad deal for policyholders, but what will happen is carriers that have guaranteed loan interest provisions, if everyone takes the loan option, like everyone's illustrating in the ledgers, their caps are going to fall way behind their peers. In a high interest rate environment.
Well, when I'm looking, you and I were at a convention together where we were talking about low expense IULs, and you used in your public, you were using Lincoln Benefit as an example.
Right.
All right. Now I'm looking at Lincoln Benefit. They have one of the lowest expense loads, so that's good. I already feel good about that.
Right.
But they also are one of the few carriers, and I don't know hardly anybody else in the United States anymore that does zero net cost loans guaranteed in the contract, access if you have gain day one. Well, and they don't have arbitrage. I think they're coming out with a new product on this.
Right.
But if I was a purist and I said, I cannot hassle everything you just said, I mean, because the arbitrage loans, I mean, if I have 5% and it goes down to 2, I'm going to hate myself in the morning. Yeah. If it doesn't perform, I had 4 of the last 10 years that were bad S&P years. You should have punted and went to withdrawals to basis, which everybody told me withdrawal to basis a year ago. They said it was blasé. I said, I need an escape method. I need a way to exit out of this. And withdrawals have been the way to do it. But I'm really, this expense load, like zero net cost loans, we're showing vapor on paper on arbitrage loans. I mean, if it's a great year, all those issues, everything goes perfect.
And it's always a great year in the illustration.
Yeah, on the illustration. So I want to go back. If I was down and playing with the index on a zero net cost loans like LBO with a low expense charge, and I told everybody, I just want to see both. Show me your arbitrage and show me that. I think people would look at what I call bookend quoting, the tale of two cities here. They would get a better idea of what's really going on. I'd rather sell the non-arbitrage, zero net cost loan, using LBL as an example, because that is so close. That's so much closer to reality.
Well, it's closer to reality. It's also quite a bit simpler, like you said, and also too, it's an issue about disclosure with your clients. So how do you fully disclose the risk inside of a variable loan structure with a very expensive policy with very high caps? There's all sorts of issues with that, right? So policies that have very high expenses now and high caps. The cost convergence is going to be greater in the future, so their caps may come down relative to their peers, but they're just packing in additional policy charges right now to get higher caps. So the caps are going to change. You have variable loans, those are very complicated. Then you have something like LBLs, which is much simpler, much more straightforward. And so, how do you disclose for the risk on the complex product side? I don't think there's any adequate way to do it because most producers are not options experts. They're not actuaries. And LBL's product and others like it basically give them a free pass because it's so simple. So the other issue too is you got to know your client. And so not only is it hard to disclose these things, and just showing the illustration vapor on paper, I totally agree with you. That's completely insufficient. Disclosure is not an illustration. Disclosure is about 1,000 illustrations. So you got to know your client. Are they bullish or bearish? Are they willing to take a lot of risk for a potential higher return? Are they not? And in 30 or 40 years, are they going to want to have a product that is simple and conservative versus what they want right now, right? Because when you're 65, you want something different than when you're 45. So if we're selling these for the long run, you got to keep that in mind. And that's where I think this story about fixed loans and whatever else, that's a great story because most clients who are buying IUL are pretty conservative, and if they weren't, what would they be buying? Right? They'd be buying VUL, And so basically, you look at these high-cost, super risky products, and go, that's not really what IUL is designed to do.
Right.
IUL is designed to be a risk mitigation product. And companies like LBL and AXA and others who said, hey, we're not going to do variable loans, or even John Hancock, they put a lot of disclosure on theirs, or Nationwide put a lot of disclosure on theirs too. These companies are saying, look, this is not a risk product, this is a risk mitigation product, and so you shouldn't expect ridiculously high returns from it because that wasn't what it was built for originally.
When I think about the future, I mean, we're talking 15, 20 years out. What are the loans going to be like? We're talking about 20 years from now.
Who knows?
Playing in these loans, and that's why I do have an affection towards contracts like Lincoln Benefit, who guaranteed in the contract. It's a zero net cost provision. I like that. Now, the other issue, the mechanic is, I really would like to see us become more broader in our approach on illustrations so that we can show the yin and the yang. If I show 5-5, I think I'm showing an in the game number, which still beats 99% of the whole life market. So it isn't like you're going to lose on that issue. But I want to be able to frame the argument in such a way that there's a good chance that this actually may take place, unlike all the illustrations of the past. And believe me, after 30 years,
you've seen a lot.
I've seen a lot of illustrations. Well, you can watch our show, of course, always on www.brokersalliance.com, or you can call us 1-800-290-7226. And remember, that's the buzz on the biz for today. You've been in the Business Insurance Zone with me, Steve Savant.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.